Hi, my name's Matt Sametz. I'm the founder and chief financial strategist at Fortress Financial. What I want to talk to you about today is the lovely glittery gold. Um, when I talk about gold, by the way, silver plays into it as well. They're basically attached to the hip. Silver is only a little different in that it's also an industrial metal, and when economy's slow, there's less demand for it. So, gold, though, it's viewed as the safe haven. Let's talk about why and when it does well and why we think it will do extremely well in the future. First off, gold is a monetary component. It's the oldest currency there is. There's no currency that's lasted as long as this has. Currencies come, they go. What we have today is what is called fiat currencies. And what that simply means is the currency that's in your pocket, look at the bill that's on you, it's only guaranteed by the issuing government. There's nothing backing it. Previous to 1971, actually, gold backed currencies. So it gave it stability and strength. President Nixon pulled that attachment away, and now what happened is worldwide all currencies are fiat. I'm not sure if I feel that comfortable with that because governments are going broke. That's just the reality. We write about it all the time, and whether or not it's tomorrow, next month, a year, 10 years, we're heading some serious monetary and fiscal challenges. We think it's coming. We write about that constantly, and hopefully you'll read our blogs and understand why. But getting back to gold, gold itself tends to do really well during periods of chaos. Are we in it? No. But why is it done? We've been through some really challenges over the last 16 years. Let's go back to 2000. It was the tech wreck. That was the beginning of gold starting to play. Its bottom was in 2001, and it ran steadily up to 2011. It's been in a constant correction mode from 2011 for 4 years to 15. Now we're seeing a bottoming pattern. We're going to talk about where the opportunities are because things tend to go in two major phases. The last gold run, first off, was in 1970s. It had the initial run for a couple of years, then a big correction. Then it had the massive final run right up to 1980, 81, where it exploded higher. We actually haven't even, on inflation-adjusted basis, hit the peak of that cycle, and times are dramatically worse today, and I'll explain why they're worse. First off, debt. Debt is at unbelievable, historically high levels, and that's across the board. That's governments, who have rapided up debt like crazy since the financial crisis of 2007 to 9. Individuals in Canada here, we're at record debt levels. The debt to income levels are 165%. That is incredibly high and a lot higher than the US was at their peak in 2007. And it's the same in Europe, in Japan, in China. Unbelievable debt increase. So that's a problem because at some point you can't keep increasing debt, and that's the only thing that's keeping growth alive. So you got a problem with that. Number two, demographics. Reality is we're an aging society. As people get older, they need less. They actually downsize. When you have the biggest portion of any economy being the consumer and the consumer shifting, profits will shift. Of course, there's going to be certain opportunities. Look at things, common sense, retirement homes. You look at a company that's buying retirement homes, probably an opportunity if they're doing it well. But there's going to be other sectors that could be absolutely devastated in it. So that's where we help people, and it's using some common sense, but beyond common sense, some really thorough cycle, fundamental, and macro thinking. So gold again. Why will gold play? Well, simple. We think there's going to be huge problems with sovereign debt. Interest rates now are down to close to 0%. Throughout much of Europe, it's negative. In Japan, it is negative interest rates. Negative. Mind-boggling. Will we see that in North America? We at Fortress say it's coming. When things get bad, central banks do anything they can in their power to try and keep things afloat versus letting the natural cycle take its course. That's a shame because all that's doing is deferring the problem and making it bigger and bigger and bigger. The bubble today is dramatically bigger than it was in 2009 when they could have let it fully deflate, could have done deleveraging of debt, could have restructured economies, but instead they said, no, let's double down. Let's take more debt. Let's keep this thing alive because we don't want it to falter under our control. Thanks, guys. You're going to make a disaster for everything. Anyways, so what will happen? Money will flee towards safe areas. If sovereign bonds, which historically have been the safest, and U.S. bonds have always been the safest, U.S. is now in monster debt problems. 19 trillion in debt, over 100 trillion in unfunded liabilities. They cannot ever honor these things. Never. There's not a chance. All they're doing is kicking the can down the road, hoping some magic will happen, and no magic's happened. It's the opposite. that things are getting worse because, like I said, demographics, lower confidence, and incredible debt levels. When you have debt, you just can't keep it taking more on, which stimulates growth. So we're at the point now where you're not going to see a lot of that. You're going to see, we believe, major contraction, major deflation in prices, which we've seen started in commodities, where look at the average commodity down 50, oil's down about 60, 70%. Monster corrections. That's phase one of deflation. We think stocks will follow, and we think bonds will follow as well. So there's real problems. So where does money flee? Money's got to flee somewhere. There's still money out there. A lot of it just disappears, but the smart ones say gold. Gold will be a safe haven, and you have to have a percentage of your wealth there for these type scenarios. A lot of money's fleeing now. That's where it hasn't corrected to any dramatic extent. Yes, it's gone through a correction. Every bull market does. But we think the opportunity in gold is huge. The Dow Gold ratio, this is one thing I wanted to touch on. I believe, I just wrote a newsletter on, I believe it's around 15 now. What that means is the level of the Dow, which is about 17.6, divided by, it's actually be a little lower, 2,200, which is the gold price. So we believe, if you look at history, back in the 1930s when it was a devastating depression, back in the 70s when there was hyperinflation and a real mess, both were huge secular bear markets like we're in today, the Dow Gold ratio went down to about 1 or 3. We think we're going there again. So just think about that. Let's say the Dow does correct to 10,000. Painful, from 17.6 to 10,000. It's taking world stocks down with it, by the way. It won't just be one indices. That's one of the safest in the world. But in that scenario, say it's a 1-to-1 ratio. What happens to gold? Gold, in essence, is going to go to 10,000. Wow, 10,000 from 2,200. My math's pretty good, and that's nearly a 5-fold return. Unbelievable. Even if it's 3-to-1, if it goes to 10,000, you're talking about 3,333 from 2,200. A nice up move. Are we, can we absolutely say this can happen? No, we follow trends. We let markets tell us. We learn from history. We research. We use cycles, which are very, very negative today. So we do everything we can to present the truth, the realities, the opportunities. And our portfolios are outperforming indices and money managers by a mile. Simply, it's not as tricky as the industry makes it look like. They make it look like there's this Chinese wall and they're geniuses behind it and they can't give you. You know how they're geniuses? By chipping away at your wealth. By taking a little bit from you and the person next to you and the person next to them. Think about it. The more that they do, that 1% they take off everyone year after year after year is huge. That's why most advisors are wealthy. Not because they're really good at what they do. Other than the sales side, they're really good at sales and fooling a lot of people to making them believe they absolutely know what they're doing. Sadly, most don't. Their job is to be salespeople. Hold your hand when things get tough, but keep charging fees. Our job is strategists. Get you out when necessary, teach you how to minimize your fees, do all those kind of things. We're proud of what we do. This industry desperately needs it, and we're having fun helping out a lot of people. Thanks very much. If you own gold, by the way, disclaimer, we don't say to anyone, buy it, because we don't know your situation and we're not licensed to work with you directly. But we do say, consider it. We have a report on our website you should look at. It's how to buy gold. Even if you got $1,000, you can buy gold. There's ways to do it. Click onto the link. There's ways to store gold, how to buy gold, all those type scenarios, because there's smart ways to do it and bad ways to do it. Thanks. We'll talk to you soon.